Welcome to A to Z Equities, where we analyze all US listed stocks from A to Z, starting with ticker A, Agilent Technologies. So, what we're going to do here is go through a number of the more objective fundamentals on this company. We're going to rate the company in five different categories. So, we're going to rate them on industry, price, growth, financial position, and management based on the most objective metrics that we can find to indicate how the company is doing in these different categories. We're going to rate them from 1 to 5 stars in each category. And at the end, we're going to give them a blended average rating from 1 to 5 stars and determine where Agilent Technologies stands on these fundamentals. Now, obviously, we're not going to get too deep into Agilent Technologies. We're focusing on more objective things that we can easily evaluate. We're not really getting into the quality so much of the company. We're getting more into the valuation. Nothing in this video is financial advice. Nothing in this video is anything other than my own personal opinions going through things. I do not have any position in Agilent Technologies. So, with all of that said, let's get into it, starting with industry. What does the company do? So, starting with the investor relations page, we'll scroll down a bit here. Corporate profile. Agilent Technologies is a global leader in the life sciences, diagnostic, and applied chemical markets, delivering insight and innovation that advance the quality of life. Agilent's full range of solutions include instruments, software, services, and expertise that provide trusted answers to our customers' most challenging questions. Okay, so not too much here in terms of what they do. Clearly, they're in the life sciences, diagnostic, and applied chemical markets. That sounds pretty good on its face. These are industries that are growing. Sounds like there is a medical aspect, a scientific aspect to what they do, but not getting such a clear picture. So let's move over to Wikipedia. Not every company has a Wikipedia page, certainly not one with a lot of detail. Agilent happens to be a bigger company, and so let's see what further information we can get here about the industry that Agilent operates in. So, Agilent is a global company centered in Santa Clara, California, that provides instruments, software, services, and consumables for laboratories. So, yeah, very much a scientific based company. It looks like they are a supplier of hardware, instruments, software, and other services for and supplies for laboratories. So, in terms of products and services, as you can see here, they serve analytical laboratories as well as clinical and routine diagnostics markets. So, yes, so as we suspected, there's a bit of a medical aspect to what they do as well. Um, I'm not even going to try to read these examples of the equipment and software and services that they sell to these laboratories. But as we see, they very much they're involved in um, business intelligence, equipment management and service, software maintenance, regulatory compliance, sample prep, genomics, cloning. So uh, in terms of all of this, I'm not going to say that I have the best idea of exactly what Agilent does. However, just based on what I'm seeing here, I would give them a 3.5 star rating for industry. The industry category looks like they operate within a growth industry, an industry with a solid long term outlook in terms of scientific research, medical research, laboratories. So we're going to give them 3.5 stars for industry. Moving on to price. So this really goes to the valuation of the company. And we're going to take a look at the company financials. So the we're just going to go through some price ratios to get a good idea of how the company is priced. The higher price the company is, the higher the ratios are, the lower score it's going to get. Lower price ratios can indicate that the company is undervalued. And so a lower price ratio profile will give the company a higher score in the price category. So, in terms of revenues, so we're using Seeking Alpha's tools here. Let's first get a picture of what the company's market cap is. The market cap is the total value of all the stock outstanding for the company. So, the market cap will be listed right here, just waiting for it to refresh. And as we see here, Agilent's market cap is $41.25 billion. So that's a pretty big company, clearly a large cap company. And moving back over to the financials. So now we're going to be able to get the price ratios for this company. So as we can see, on a trailing 12-month basis, that means the last reported 12 months for the company. Companies report earnings quarterly. And so the last 12 months are the last 4 quarters that have been reported. We can see that revenues are about $6.6 billion. So if we just pull up a calculator and we plug in, if we want to get the price to sales ratio, meaning how many times sales, how many times revenue is Agilent selling for. So the market cap again is about 41 billion divided by 6.59. And so we get a price to sales ratio of about 6.2. So that's pretty high. It's a pretty high price to sales ratio. Um, in terms of their price to earnings ratio, which is how many times their net profits they're trading for. So here we have their net income to common shareholders, which is the same number in this case. So that's a good sign. We go back to our calculator and we're going to divide 41 by 1.24, and we get a price to earnings ratio of about 33. So a price to sales ratio of about 6.2, price to earnings ratio of about 33. I would say that the price to earnings ratio is a little more favorable than the price to sales ratio, which is quite high. The price to earnings ratio is not as high, but also pretty high. The market average typically ranges from mid-teens to mid-20s. Right now, it's closer to the top of that range in the S&P 500, trading around the mid-20s to earnings, and so at 33 or so on a trailing basis, Agilent is definitely above the market average, which again indicates that its price may be kind of expensive. Now, of course, price varies based on a lot of different factors, and we're going to look at a couple more of these metrics. And a high growth company would be able to justify that better, and we're going to get a higher price, and we're going to get into growth in the next category that we rate after we rate price. And so let's see what their free cash flow looks like. So we have down here levered and unlevered free cash flow. I like to look at levered free cash flow because that is that accounts for debt payments that the company makes, interest payments on its debt, and that's just a more accurate way of looking at things since those debt payments are a real expense. And so, as we see, their levered free cash flow is 924 million. If we divide 41 billion by 924 million, we get a price to free cash flow ratio of over 44. And so, the price to free cash flow is quite high, I would say. Now, a lot of companies don't have any free cash flow, and so it's good that this company is profitable. It's good that Agilent has free cash flow. But that said, the sense that we're getting so far is that Agilent sells for a pretty expensive price. Now, we'll see how justifiable that might be when we get to growth. If they have strong growth, they'll get a good rating in that category, but it's not looking like they're going to get such a good rating in terms of the price category. Now, moving on, we're going to look at just a couple more metrics here. So we want to know their price to book value and the price to tangible book value, to get a more full picture of the price that the company sells for. The company's book value is its assets minus liabilities. So what we're looking at now is the balance sheet. This shows cash and short-term investments, all of the short-term, the current assets of the company. Then we have long-term assets. We see here that the company has a little bit of goodwill, more than a little bit, about 4 billion of goodwill. Those are intangible assets, including other intangibles that have over 4 billion in intangibles. So that's going to inflate the book value, the assets minus liabilities, over the tangible book value, which is the tangible assets minus liabilities. And so we see they have 10.8 billion in total assets. That's going to be closer to like 6.4 billion, 6.5 billion. Intangible book value. Now they have close to 2 billion in current liabilities. Those are short-term liabilities like receivables, uh, accounts payable. Accounts receivable would be in the current assets category, but accounts payable is in the current liabilities category. Short-term borrowings, and other current liabilities. In the long-term liabilities category, we have debt, at a little over 2 billion. Not too bad for a company of Agilent size. It's not a ton of debt. But in any event, getting down to the price ratios, we want to compare the company's stock price to its book value and its tangible book value. And so here we see that the book value is, well, the book value is going to be here. Total equity 6.2 billion. Equity, in this case, is another word for book value. And so what we're going to do is we're going to divide 41 billion by 6.2 billion, and we get a price to book of about 6.6. Now, that's not terrible, in the sense that a lot of companies have higher price to book ratios, which are more expensive. Many companies have negative price to book ratios if they have more debt than assets. So Agilent has more assets than debt. But at 6.6, that means that for every dollar of, of unencumbered assets that the company has, you're paying $6.60 approximately, for that dollar of assets. And so that's not so favorable. And that is above, kind of a safety net in terms of the assets on the balance sheet. You don't exactly have a safety net there. Looking at the tangible book value, so that's going to be over here 1.8 billion. So we're going to divide 41 billion by 1.8 billion and we get about 22.8. So the tangible book value of this company is 22.8. That means that for every dollar of tangible assets minus the liabilities, so unencumbered tangible assets, for every dollar, you're paying about $22.80. And so again, you're not getting a margin of safety there, when we look at these ratios. So all in all, I'm going to say that Agilent looks pretty expensive. And again, some companies can justify being expensive. A lot of companies look a lot more expensive than Agilent on a price to, all these different metrics, these price multipliers. A lot of companies look a lot more expensive. But that said, Agilent is definitely up there, and so it can only get 2 stars out of 5, for price. So moving on to growth. And so we're going to be looking at the financials again, these same statements, the income statement, which shows us how much the company is bringing in terms of revenue and earnings. The company's expenses as well are on the income statement. The balance sheet, which again shows the assets and liabilities of the company, and the cash flow statement, which shows post earnings, where the money's going, and other sorts of expenses and inflows and outflows of cash, and shows us the free cash flow ultimately of the company, how much money the company is actually bringing in or losing, or sending out the door. So what the cash position looks like, and the cash flow statement gives us a picture of that. So for growth, we're going to be looking at the income statement largely. and we want to know how the company's growth looks. So here we have the last 10 years of earnings, the last 10 years of the income and expenses of the company. So as we can see in October 2014, revenue was 4 billion, and now revenue is 6.6 billion. It's pretty good growth over the course of a decade. It's not phenomenal, but it's pretty good. We've seen growth most years. 2015 was a little bit of a dip, then 2016 back to growth in 2017, 2018, 2019, 2020. Every year consistently, this company's been growing up until 2023. And now 2023 was relatively stagnant as compared to 2022. And then in 2024, clearly, what's been reported so far has fallen off from 2023. And so it looks like this company has a very strong track record of growth, but right now, things are not going so well in terms of revenue growth, top line growth, how much sales, how much they're bringing in at the top line. Not doing so great at the moment, but they do have a good track record. So we are going to factor that in to the analysis. And so moving on down to income growth, we can see that the net income has actually fared better recently. It's also more than doubled over the last 10 years, so that's better than the revenue as well. We've got a clear picture. 2015, like with the revenue, the net income dipped. However, they got back on the growth track. It's been a little less consistent than the revenue, which is often the case, especially with GAAP earnings, generally accepted accounting principles earnings, which is what's used on the income statement. There's also non-GAAP earnings, which we're not looking at. But in terms of their profit since 2021, it's been relatively stable in that 1.2 billion range. So the net income looks pretty good, but it also looks like that growth has sort of stagnated over the last few years. So let's also take a look at free cash flow growth over here on the cash flow statement. So scrolling down, levered free cash flow has been very inconsistent to say the least, but since 2015 they've had positive free cash flow every year. Um, I'm not going to say that there's a strong track record of growth here because it's been very inconsistent, but I will say it looks pretty, reasonable, pretty decent. They're bringing in good cash, but in terms of growth, not such a great track record. Obviously, 2014, there was a free cash flow loss. Every year since then has been a gain, but I'm not really seeing strong growth here, if any growth at all. So, lastly, let's take a look at the growth forecasts for this company. So, what are the analysts expecting? And that's going to go over here to earnings estimates. And the earning estimates are going to tell us for the next couple of years, what do the analysts expect in terms of the revenue and the earnings. So let's start with the revenue here. 2024, excuse me. The revenue estimate is 6.46 billion. So that's projected to be a 5% year over year decline. And we already saw on the income statement, the revenue is not looking so good this year. 2025, though, expected to get back on the growth track with about 6% revenue growth. 2026, we accelerate to over 7%, over 7% in 2027, over 7% in 2028. So the analysts are expecting pretty strong growth for this company over the next few years, not runaway growth, but very solid, excuse me, very solid high high single digit growth, I should say, starting this year, starting next year. So October 2028, 8.45 billion. That's significantly higher than where we are today. That's pretty good, and that's definitely going to help the score here. So overall, I'm going to say the revenue, you know, This year, 2024, looks like a little bit of an aberration. They've had a strong record of revenue growth. It looks like analysts expect that to continue. If we look at the earnings estimates here, for 2024. Again, a little bit of a dip, but then getting back to high single digit, even low double digit, over 10% EPS growth in 2025 and 2026 is expected. So it looks like the earnings are expected to, start increasing again after we saw the last few years they've been a little stagnant. Now, analyst estimates should always be treated with a little bit of skepticism. Nobody really knows the future. Analysts incentives are a little bit skewed in the market. But all of that said, these estimates certainly look encouraging for this company, more encouraging than the backwards looking record on the income statement looks. So overall, I'm going to give the company a score of 3 stars out of 5 for growth. It's definitely right now, what we're seeing right now is not strong growth at all. Actually, we're seeing a little bit of a contraction, but it looks like they're going to get back on the growth track, maybe even post a little bit above average growth. So we got to give them a little bit of a bonus for that. And I think the 3 stars out of 5 is fair, considering that right now they're not doing so great. Their cash flow isn't really growing, but it looks like analysts expect them to get back on the growth track pretty soon. So moving on to financial position. So the company's financial position is going to be based on the balance sheet. It's going to show us how strong the company's position is. We've already alluded to this a little bit in going through the price ratios, but we didn't factor this into the price category. And so now we're going to look at the financial position and get into exactly how strong the company's financial position is. So, returning to the balance sheet. So, the first thing we want to look at is the company's current ratio. That compares the company's current assets to current liabilities. We see the current assets here, 4.2 billion. Scrolling down to current liabilities, we have 1.95 billion. So that's a really good current ratio. Current assets are more than 2 times current liabilities. That means over the next 12 months, the short term assets the company has, like cash and receivables, are more than 2 times the short term liabilities, meaning money that's going to have to go out the door in the next 12 months. And that is really favorable. Current ratio over 2 is considered very solid, so that's a good start in terms of the company's solvency. It indicates the company's not about to go bankrupt, certainly within the next 12 months. And so that's a very positive sign. Now, turning to long term debt, we already saw this. Let's take a look at it again. The company's long term debt is 2.1 billion, and it's actually coming down. It started escalating in 2020, and it's been coming down since then, down to 2.1 billion. That's not bad at all, especially compared to the company's market cap, compared to the company's assets, even the company's tangible assets, even the company's net cash, if or the company's cash position, right? Because long-term debt is 2.1 billion, cash is 1.7 billion. So the company could pay off a significant majority of its debt with cash on hand right now. And so that's a pretty good sign as well. Indicates that the company is not over leveraged and in a strong financial position. Now, in terms of debt to earnings, right, if we were to compare, so, how quickly could the company pay off its debt based on its current earnings? So again, debt, as we saw, is about 2.1 billion. Looking at the income statement here, net income about 1.2 billion a year, a little over 1.2 billion a year. That indicates within less than 2 years the company could take that net income, pay off all of its debt. And again, that's a good sign. It shows their debt is pretty negligible compared to their earnings potential and their ability to pay that debt off. Again, indicating this company is not over leveraged and not at risk of bankruptcy or running into any serious financial issues. Let's also see, while we're on the income statement, let's take a look at interest expense up here. And they actually have a negative interest expense. And, I don't know why this is, and obviously we would have to get a lot deeper into the company that we're getting in this video in order to determine why there's a negative interest expense, and they've consistently had a negative interest expense. That means that they're actually getting income from interest as opposed to paying money out as interest. And again, the fact that they have low debt is very helpful in that regard, but seeing a negative number here is pretty rare, and that's very beneficial for this company. So, in terms of the company's financial position, although they do not have a ton of book value or tangible book value, as we saw previously, everything else looks really good. And so the company is going to get a 4 out of 5 star rating for financial position. And then lastly, we're just going to turn to management. Now, management is one of the hardest things to assess about a company, about any company. The reason being that it's very subjective, tends to be very subjective. I could look at the management's resumes. We could pull up from the investor relations website. What's the CEO done before? What's the CFO done before? What have the directors done before? What other companies are they the directors of? But all of that is very subjective, and it doesn't really give us the ability to determine how the management is doing. And so, in rating the management company, I want to take a look at more objective factors. And so, one of those is going to be simply how is the company performing versus its forecasts. And so, this is something else that Seeking Alpha can help us with. And it shows here EPS surprise and estimates by quarter. This just shows how the company has done versus the estimates and as we can see in the last 4 quarters, the company has beaten estimates every time. This blue column shows the actual results versus the black column, which shows what the expectations were, what the analysts expected the company to do. And as we can see, they consistently beat analyst estimates. Um, and so that's a really good sign, um, which um, shows that they're outperforming. And if we scroll over to this column, we can actually see in the last 2 years, so the last 8 quarters, every single quarter, this company has beaten both on earnings per share and on revenue. So that's really, really good. And that shows that the management is under promising and over delivering. They're managing expectations and then beating those expectations. That's a really good sign. And it indicates a good management team that's certainly not over promising or giving the market too much hope. If anything, they're setting expectations low and then beating them. That's something that I love to see in the management teams of the companies that I invest in, and so they're going to get a lot of credit for that on the management front. Now, in terms of insider transactions, that's something else that we'd like to see. Um, so, how insider transactions are in the last 6 months here shows how many shares insiders have purchased and sold. So we see that for every share that they've purchased, 37,900 here, they've sold they've sold more than 2 shares for everyone that they've purchased because they've sold 82.4 thousand shares. Now, all of that is not such a big percentage. That's a net 5.4% reduction in the total insider shares that they hold. But all of that said, that is not, you know, the fact that they're selling more than they're buying. It's not great. It's not a great sign because obviously, when insiders are buying shares, it shows that they have more of a stake, and more optimism about the company. But then again, as it's commonly said, insiders sell shares for many reasons. The selling here is not so high. The total shares sold is a little over 10% of the total shares held. The net shares sold is about 5%. So we're certainly not gonna lose any sleep over that. And then lastly, we're just gonna take a look at the share count of this company. And the share count is pretty important because it shows an increasing share count is a sign of a management team that is diluting shareholders, while an while a decreasing share count is a sign that management is increasing the ownership of investors over time. And so, as we see here, this is actually really favorable. Since 2014, the number of shares has come down by well over 10% from 338 million to 294.5 million. They're going to get good marks in this regard. So, between the different categories that we've looked at here in terms of how they perform versus forecasts, insider transactions is the one potential weak spot here. Share count is looking good. It's coming down over time. We're going to give the management team actually a score of 4.5 stars here, which is a really, really good score just based on the few metrics that we looked at. Again, more objective things doesn't really matter, or it's much more subjective. Obviously, you may want to look into, the CEO's resume, but that's something which we can't really analyze in such an objective way. We're trying to stick to more objective things here, things that don't require as deep of a knowledge and intimacy into the company. And so, based on these different factors that we've looked at, we're going to give the management team a score of 4.5. And so now for the fun part. We're just going to add up. We've ranked this company. We've seen all the kind of objective things that we wanted to see about how the company is doing. We've ranked them in five different categories. So now we're going to tally up the average of these five scores that the company received across different metrics, and we're going to assign a total score, slap it on the company. How many stars does this company get out of five on a total basis based on these five scores? So, what's the blended 5 star score? So, again, for industry, companies scored 3.5 stars. On price, Agilent scored only 2 stars. On growth, Agilent scored 3 stars. Financial position, 4 stars. Management, 4.5 stars. So, definitely an improvement in the back half there for this company. And now, what is the total blended score? So, out of those five scores, the average score comes out to about 3.5 stars, approximately 3.5 stars. And so, that's the rating that this company is going to get. Agilent Technologies, 3.5 stars. And again, this is not financial advice. This is not a buy or sell recommendation. I personally don't have any position, long or short, in this stock. But I hope that this information is helpful in terms of helping investors understand a little bit more about this company, a little bit more how to rate stocks in general, how to evaluate them, and a little bit more information on these different categories for Agilent in particular. 3.5 stars is the score. Thank you for tuning in to A to Z Equities, and we hope to see you back on another video very soon.